What if you could see exactly where the big institutions buy and sell, and follow their footprints instead of fighting them? And what if you could read the market the same way Munehisa Homma did, the man who made the equivalent of $10 billion using nothing but candlesticks and human psychology 300 years ago? Today, I'll show you how to combine his ancient Japanese method with modern smart money strategies to build a 5-minute scalping system that moves with the banks, not against them. Here's what you're about to learn in this video. Who really moves the markets? How big institutions buy and sell without you noticing? How to spot institutional areas before the move happens. How to validate the strongest smart money zones. How to use Munehisa Homma's 300-year-old candlestick secrets for perfect entries. The 5-minute scalping strategy that works on any market. How to trade with the banks, not against them. The simple risk management rule that keeps you profitable for life. By the end of this video, you will read the market like institutions do. Predict the next market moves before they even happen. Adapt ancient wisdom to today's market dynamics. Apply a simple but powerful 5-minute scalping strategy. If that sounds like the kind of knowledge you've been looking for, make sure to like this video, subscribe, and turn on the notification bell, because what you're about to learn could completely change the way you read the markets forever. Alright, now that you're ready, let's start from the core. Because before you can trade like smart money, you need to know who really moves the market. It's the giants, central banks, hedge funds, market makers, and massive financial institutions controlling billions, sometimes trillions. When they move, the entire market follows. Look right here. The market was calm, almost asleep, and then out of nowhere, a strong move down. Who caused this? A retail trader with a $1,000 account? Of course not. This was a big bank or a financial institution executing a massive sell order. But why did they sell? Maybe a high-impact economic report dropped, like an interest rate decision, inflation data, or a bad employment report. Maybe their analysts spotted a macro imbalance or a liquidity void. Whatever the reason, they acted, and that action left a footprint on the chart. The market was quiet again. Then suddenly, a strong bullish push, clearly another institutional order. A wave of buying pressure, but here's where it gets interesting. After that move, price retraces back to the origin of the impulse and then moves up again. That area where price bounced? That's not random. That's what we call a demand zone. Here's what happens. When a big institution decides to buy, it can't execute its entire order at once. Imagine a bank wants to buy $250 million worth of euros against the US dollar. They can't just click buy. There simply aren't enough sellers available instantly. So what do? They might buy 100 million first, pushing price up, then wait. When price retraces back to the zone, they use that pullback to fill another 50 million and another opportunity to fill another 50 million. Once the market keeps rising, they complete the remaining order. And that's why you see this pattern again and again. Strong move, followed by a retracement, then a continuation. It's not magic, it's the institutional footprint, the trace left behind by big money. So as a retail trader, what's your real job? Is it to analyze GDP growth, or read central bank reports, or track corporate earnings? No. You don't have access to the data they have, and even if you did, your $10,000 can't move the market an inch. Your real job is this: to scan your chart and spot institutional footprints, because those footprints show you where institutions have already acted and where they're most likely to act again. And the most powerful of these footprints? Supply and demand zones. This is the core of our strategy. I'm going to teach you exactly how to spot where institutions bought and sold, how to identify the zones they're likely to defend, and how to enter the same trades they take, with precision, confidence, and discipline. So please, don't skip any part of this video. Every concept connects to the next. If you miss even a small detail, the entire strategy could fail, and you'll miss what separates losing traders from professionals. Let's start with supply zones. A supply zone is a price area where selling pressure becomes dominant, so strong that it stops price from going any higher. You'll often see it appear after a powerful bullish move, a big rally where the market suddenly reverses. Why does that happen? Because institutions that bought early in the move are now taking profits, unloading huge positions, and when those sell orders hit the market, They overwhelm demand, sending price sharply downward. It's not just sellers entering, it's smart money exiting. That's the difference. Now, on the flip side, we have demand zones. A demand zone forms where buyers step in with force, preventing price from falling any further. Usually, it appears after a market drop when price reaches a level institutions see as cheap, a value area. They start loading up massive buy orders, and because their orders are so large, price reacts explosively upward, creating that beautiful rally we see on the chart. It's not random, it's institutional accumulation, the moment smart money quietly enters the market before the big move happens. So, in short, supply zones are areas where institutions sell or distribute their positions. Demand zones are areas where institutions buy or accumulate their positions. Now that you understand what supply and demand zones really are, let's take it a step further. If you want to predict where the market will move next, you need to recognize the 4 footprints that institutions leave behind. These patterns are like the DNA of smart money activity. They reveal whether the market is preparing to reverse or to continue its trend. Once you master them, you'll start seeing the chart the same way institutions do. Alright, let's break down the first institutional footprint, the drop base rally. This pattern tells the story of accumulation after manipulation. Here's how it unfolds. First, price drops sharply. That's not random weakness. It's smart money driving price lower to hunt liquidity, forcing retail traders to panic sell and trigger their stops. Then, price pauses and forms a base. That's where institutions quietly start accumulating buy positions, while the rest of the market is uncertain. And finally, comes the rally, the explosion upward. The moment institutions unleash the second half of their orders, sending the market flying, that whole formation, the drop, base, and rally, becomes your demand zone. When price comes back to this area later, it often bounces hard again, because the remaining institutional buy orders are still waiting to be filled. The drop base rally is the smart money signature of a bullish reversal. Now, flip that logic. The rally base drop shows us distribution at the top, where institutions are getting out while the crowd is still buying. First, price rallies, driven by institutional buying or short covering. Then, it stalls and builds a base. That's where big players quietly start offloading their positions into retail demand. Once they're done distributing, they pull the plug and price collapses. That base becomes a supply zone, a key institutional footprint. And when price later returns to that zone, institutions use it to re-enter short positions, while retail traders get trapped again. The rally base drop is the mirror image of the drop base rally. It's where smart money sells high before the fall. Sometimes, smart money doesn't want to reverse the trend, they just want to reload. In a rally-based rally, price makes a strong move up, then pauses. Retail traders think momentum is dying, but institutions are actually adding more to their buys. That pause, that base, is a moment of controlled accumulation, and when the second rally begins, it confirms that demand is still in full control. When price later pulls back to that base, that's your continuation demand zone, a high probability area where buyers defend the trend. Think of the RBR as smart money's refueling station in an uptrend. Finally, the drop base drop. Here, the market is already in a downtrend. Institutions pause just long enough to gather liquidity, that's your base, and then they hit sell again, continuing the move lower. This pattern represents redistribution, where smart money re-enters the trend to push price deeper. That base becomes a supply zone, and every time price revisits it, it's a potential opportunity to join institutional selling. The drop base drop is simply the bear's reflection of the rally base rally, a continuation setup executed with precision by smart money. These 4 patterns are the building blocks of every market move. They're not just price shapes. They're institutional footprints, the physical traces of smart money activity. And here's the best part. They repeat over and over again across every market and every time frame, because human psychology and institutional execution never change. Now that you know how to spot supply and demand zones, let's take it one step further and make sure you're focusing only on the best ones. Because here's the truth, not all zones are created equal. Some are strong and explosive, others are weak and will fail the moment you touch them. And as scalpers, speed is everything. We don't have time to sit through slow, uncertain setups. We need zones with momentum, zones that can deliver fast, reliable moves. So before you take any trade, you must filter your zones using 4 key criteria, the 4 pillars of a valid institutional footprint. The first clue comes from the candle size behind the move. When institutions enter the market, they move price with power. You'll see large, clean candles, consistent in color, minimal wicks, and strong direction. That's how you know smart money is involved. Their orders create clear imbalances, a sudden push that retail traders simply can't replicate. But when you see small, uneven candles with mixed colors and long wicks, that's a sign of indecision, not institutional strength. Skip those zones. You only want the ones that scream volume and conviction. The second factor is freshness. A zone is strongest the very first time price returns to it. Why? Because that's when unfilled institutional orders are still sitting there, waiting to be triggered. Once price revisits and reacts, those orders get filled and the edge is gone. So when you trade, always prioritize untouched zones. Fresh zones tend to give sharp, clean reactions, perfect for scalping. If a zone's already been tested once or twice, treat it as weakened or even invalid. Remember, smart money doesn't leave footprints forever. The third factor, and one of the most important, is the break of structure. When a zone is truly institutional, it's strong enough to break through key levels, previous highs, lows, or consolidation ranges. That breakout isn't random. It's smart money driving price beyond retail stop losses, creating a liquidity sweep and shifting market structure in their favor. When you spot a zone that caused a clear break of structure, you've found a powerful institutional footprint, a zone that truly mattered to big players. Finally, and most importantly, never touch a zone unless it gives you at least a 2-to-1 reward to risk ratio. This rule protects you long-term. Even if you win only half your trades, your profits will still grow because every win covers multiple small losses. If a setup doesn't offer that 2-to-1 potential, skip it. Remember, good traders don't take every trade. They take the right trades. Alright, let's jump into a real chart example so you can see exactly how to apply the rules we just learned. Here, we've got a potential demand zone forming, but before we assume it's valid, let's break it down step by step and test it against the 4 filters we use to confirm whether a zone is truly institutional quality or just another trap. Take a look at the candles that leave the zone. Notice how they're large, clean, and moving in one direction? That's exactly what we want to see. When candles expand like this, especially with little to no wicks, it's a strong indication that institutional money is behind the move. Big players don't move price slowly. They move it with force, and these candles are their footprints. Now let's check if the zone has ever been tested, and as you can see, this one is untouched. That means it's fresh, and likely still filled with unfilled buy orders from smart money. When price revisits this zone for the first time, there's a high probability of a strong reaction, and that's the kind of move we're looking for as scalpers. Next, take a look at what happened after the move began. Notice how price broke above a previous high? That's not random. That's a break of structure. When a move breaks through a key level, it confirms that institutions were in control, and it often traps retail traders who were still shorting the market. This is a clear institutional footprint, a textbook sign of a strong demand zone. Finally, we calculate the risk-to-reward ratio. From this entry point, the potential setup offers around 3 times more reward than risk, exactly what we aim for. This 3-to-1 ratio keeps us profitable over time because even if we don't win every trade, our risk management ensures that one win can cover several small losses. Now, look at what happened next. As you can see, once the market retraced back and reached the zone again, it was rejected and moved upward, exactly as expected. Now that we've learned how to identify a supply or demand zone, the next question is, how do we know if it will actually work? Because not every zone will react. Some are traps, some are weak, and some are just noise. So how do we confirm the ones that truly matter? The answer lies in a 300-year-old trading method, created by the man who first decoded market psychology, Munehisa Homma. Homma was a Japanese rice trader from the 17th century, and he's widely regarded as the father of candlestick charting, the very tool every trader in the world uses today. He didn't just create candlestick patterns, he understood that every candle represents emotion, fear, greed, hesitation, and conviction. Historical records say that Homma made the equivalent of over $10 billion in today's money, just trading rice futures. His success was so legendary that he was eventually appointed as a financial advisor to the Japanese government, and later honored with the title of samurai. But more important than his wealth was his discovery that price movement is nothing more than human psychology visualized. One of the candlestick patterns Homma relied on was called Tonkachi, which means the hammer. He observed it after long, exhausting downtrends, when sellers kept pushing price lower and suddenly a candle appeared with a small body near the top and a long shadow below. Homma said it was like the market was speaking. That long wick represented rejection, buyers stepping in with strength, saying enough. He described it beautifully. When the shadow grows long below, it is the voice of the market saying the fall has ended. That single candle marked the moment where panic turned into opportunity, where smart money began quietly stepping back in. Let me ask you something. Does the tonkachi, the ancient hammer candle, still work in today's market? Let's find out. Here's a real chart. Price falls sharply, a tonkachi forms. Exactly the pattern Munehisa Homma described centuries ago. By his logic, this should signal a reversal upward. But look what happens. The market keeps falling. So, does this mean Homma's method stopped working? Absolutely not. His method still works, but the world has changed. In Homma's time, there were no hedge funds, no central banks, no algorithmic trading engines. Back then, his method was the algorithm. Today, the battlefield is different. We trade in a market controlled by institutions and coded systems, players who move billions and create artificial liquidity to fill their orders. So if you trade a tonkachi blindly, without understanding where smart money is active, you'll get crushed. Not because Homma was wrong, but because you're not the one moving the market. Remember, your $10,000 doesn't control price. Their billions do. That's why you must first spot the institutional footprint and then use Homma's candle as your confirmation. That's when his 300-year-old wisdom becomes powerful again. Let's make this clear. Look at this chart. We've just identified a clean demand zone, a clear institutional footprint. The candles are strong, the structure is broken, and the zone is fresh. It checks every box of a high-quality zone. Now watch what happens next. Price retraces back to the zone, and what forms right inside it? A tonkachi. That's your confirmation. You've got two worlds aligning, institutional activity from modern smart money and emotional reversal from Homma's candlestick. When those two meet, that's where precision trading begins. You're not guessing anymore, you're entering with the market movers. Now let's look at the opposite of the tonkachi, the nagare boshi or falling star. It forms after a strong uptrend and warns that buyers are losing control. You'll recognize it instantly, a small body near the bottom and a long upper shadow. It tells a simple story. Buyers tried to push price higher, but sellers stepped in and rejected those levels with force. Homma describes it poetically. When a light burns too bright, it cannot last till dawn. In other words, when the market rises too fast, it burns itself out, and that's often when smart money quietly starts selling into retail enthusiasm. When the nagare boshi appears inside a supply zone, it's your warning that the reversal is about to begin. For Homma, the doji was more than a pattern. It was a pause, a moment when the market took a deep breath. When price opens and closes at almost the same level, it shows pure indecision, the balance between buyers and sellers. Homma said it was the market taking a breath before speaking again. What happens next depends on where it forms. After a strong trend, a doji often signals a possible reversal, momentum is fading. But inside an ongoing move, it's usually a continuation. The market is just gathering energy before pushing further. Either way, the doji tells you one thing: wait and watch. The next candle reveals whether smart money is ready to strike again. Now, let's move to the next candle. The tsutsumi. In Japanese, tsutsumi means to wrap or to engulf. To Homma, this wasn't just a shape, it was a power shift. When one candle completely covers the previous one, it means one side has erased the other's conviction completely. He wrote, when one day swallows another, the market's heart has changed. A bullish engulfing Satsumi age appears after a decline. Buyers overpower sellers. A bearish engulfing Satsumi Sagaru forms after a rally. Sellers take back control. For Homma, the engulfing candle was the market's confession. It reveals which side truly holds strength. And when it forms inside a key institutional zone, it's like smart money shouting their next move in plain sight. Now, let's move to the last candle, the harami. Harami means pregnant in Japanese, symbolizing one candle hidden inside another. Homma viewed it as a moment of compression, where the market's energy builds quietly before its next decision. He wrote, when the child rests within the mother's body, movement pauses, but strength is building. In modern terms, after a strong move, a harami signals slowing momentum and a potential reversal. Inside a trend, it shows healthy consolidation, the market catching its breath before the next impulse. Homma would wait for price to break out of the larger candle's range before acting. The breakout direction revealed the market's true intention. Now we've got the full picture. We've learned how to spot the footprints left by institutions using smart money concepts, and how to confirm our entries using the 300-year-old method of Munehisa Homma, the father of candlestick psychology. So now let's bring it all together and apply it to our scalping trading strategy. We're looking at the Euro-US dollar 5-minute time frame. At first, the market was moving sideways, consolidating, building liquidity. Then suddenly, a huge bullish candle bursts out of the range. Now pause for a moment and think, what caused this move? That's not retail traders. That's an institutional algorithm executing large buy orders. They accumulated positions, swept liquidity below the range, and then launched a strong impulsive move upward. That right there is a demand zone, an institutional footprint where smart money bought heavily. But before we act, let's verify that this zone meets our 4 criteria. Step 1. Candle strength. The candle that created the zone is large and clean with no hesitation and almost no wick. That's the signature of big money, decisive, powerful movement. Step 2. Freshness. The zone is untouched since the move. Price hasn't revisited it yet, which means unfilled institutional buy orders are likely still sitting there. Break of structure. Notice how the impulse broke above previous resistance, creating a new high. That breakout confirms institutional control. Retail traders who were short just got trapped. Risk to reward. If we measure from entry to stop and target, this setup offers roughly a 2-to-1 reward to risk ratio. Not perfect, but acceptable. Solid enough for a scalping setup. So far, everything lines up. We've identified where smart money bought and where they might buy again. Now, what happens next is out of our control. The market can either continue higher or retrace back to the zone. And look at that. Price retraces perfectly back into the zone. Right here, a Tonkatchi candle forms. The same hammer pattern Munehisa Homma taught 3 centuries ago. That long lower shadow is the market speaking. Sellers tried to push price down, but buyers stepped in with conviction. Remember what Homma said, when the shadow grows long below, it is the voice of the market saying, the fall has ended. This candle tells us exactly that. Smart money is defending their position and buyers are taking back control. So, now we have both confirmations, institutional footprint from smart money and psychological confirmation from Homma's Tonkatchi. That's our entry signal. Before entering, we always confirm with the higher time frame. For the 5-minute chart, our higher frame is the 30-minute. On the 30-minute chart, price has been trending downward, but recently started retracing upward. Here, we can clearly see a demand zone where the market rejected lower prices. That rejection signals a potential short-term shift to the upside, which supports our bullish plan on the 5-minute chart. We place a buy order at the close of the Tonkatchi candle, with a stop loss just below the demand zone, and a target at the next resistance level. And look what happens next. Price launches higher almost instantly, hitting our target and securing a 2-to-1 reward to risk win. Perfect execution. What we just did is simple but powerful. We used a demand zone to locate institutional footprints, we used Munehisa Homma's candlestick to confirm the entry, and we verified the trade with multi-time frame alignment. This is how you merge smart money logic with ancient price psychology and turn it into a precise 5-minute scalping system. Now let's look at another chart example. This time, it's the US dollar, Japanese yen on the 5-minute time frame. At first glance, you can see the market was trending downward and then began to move sideways, a range formation, which usually signals an accumulation or distribution phase. Then suddenly, a strong breakout. That big impulsive move isn't random. It's a textbook institutional move. Smart money first accumulates positions quietly inside the range, then releases a large order that drives price sharply in one direction. And that breakout leaves behind a clear supply zone, an institutional footprint where big players likely began selling. Before we plan any trade, we have to verify if this supply zone meets the criteria of a high probability smart money area. Let's break it down. The candles moving away from the zone are large and consistent, a clear sign of institutional selling pressure. Freshness, the zone hasn't been tested since it formed. Unfilled sell orders are likely still waiting. Break of structure, price broke out of the accumulation phase with force, a clear sign that smart money stepped in and shifted the market's direction. Risk to reward, from entry to target, this setup offers at least a 2-to-1 ratio, making it worth our attention. Everything checks out. Now, we wait to see how the market reacts when price revisits the zone. And look at this. Price retraces back perfectly into our marked supply zone, and right inside the zone, a Tsutsumi candle forms, the ancient Japanese engulfing pattern described by Munehisa Homma centuries ago. He said, "When one day swallows another, the market's heart has changed. This candle tells a clear story. Buyers attempted to push higher, but sellers completely engulfed their effort, showing dominance and emotional reversal." So now we have both elements, a smart money supply zone where institutions are likely to sell, and a Homma confirmation that emotion has flipped from buying pressure to selling power. Before executing, let's check the higher time frame to confirm. On the 30-minute time frame, the market has been ranging, but look closely. A liquidity sweep just occurred at the resistance level. Price spiked above it briefly, grabbing liquidity, then reversed sharply. That's a clear sign that smart money has filled sell orders above resistance and is preparing to push the market lower. A little further along, we can see another liquidity sweep forming here, but it quickly fails, followed by a strong bearish candle. That candle is clearly institutional. The liquidity sweep at the resistance level signals that the market might move lower and break out of the range, and the failed sweep confirms that smart money is now pushing price downward after the breakout. So, our higher time frame agrees with our plan. Everything aligns perfectly. Now, we move back to the 5-minute chart to execute. We place our sell order at the close of the Tsutsumi candle, set a stop loss just above the pattern, and adjust our target for a clean 2-to-1 reward to risk ratio. And look what happens next. The market respects the supply zone perfectly, drops strongly, and hits our target with precision. Another clean trade, executed with the combined power of smart money footprints and Munehisa Homma's timeless candlestick wisdom. If this approach resonates with you, don't forget to hit that like button, subscribe to the channel, and hit the notification bell so that you can get every new strategy as soon as it's uploaded. Thank you for watching and see you in the next video.